We are ready to go.
We can always trim this after the fact. All right. Welcome to the weekly Multifamily Roundtable. We are a group of multifamily investors from Minnesota that get together to get together every week to talk about multifamily real estate investing. We thought, hey, why don't we invite you, the listener at home, into these conversations to learn a little bit something. Like, we come together to try and learn something from each other, and you might as well benefit from that as well. So I am Anthony Vicino of Invictus Capital. Dan Kruger is my partner. Rodney is another syndicator here from the Minnesota area. And tonight we're going to be talking from a really high level, just what is multifamily investing? What's an apartment syndication? We're going to treat this as though you are brand new to real estate investing. You don't know anything. And we're going to take you in the next 3 sessions over the next 3 weeks. And we're going to take you from being a complete newbie to, actually understanding what we're talking about, how you might take part in this industry, and then you hopefully start feeling confident to start taking some action. So what do you guys think about that?
That sounds amazing.
Sounds like a plan.
Did I nail that intro?
You nailed the intro.
You guys at home, if I nailed that intro, thumbs up for me.
No. Yeah, drop a comment in the chat letting Anthony know how awesome he is.
Yeah. Yeah, I've really been struggling recently. We're in COVID times, and so we're self-quarantined. I don't get as much positive reinforcement anymore as I'm used to getting. So guys, let's talk about apartment syndication, multifamily investing. I think tonight's conversation, if we could lay the groundwork for what a syndication is, why we like it, what are the benefits, the pros and the cons, and then how people can actually start getting involved in that, I think we'll have done a good thing for the world.
Mm-hmm. Let's do it.
So where do you want to start? Like, why we should invest? Or
well let's assume somebody coming off the street right now. I'm gonna try and play the idiot. That's gonna be pretty easy here tonight. I'm gonna play the idiot. I'm gonna pretend like I'm the new guy who doesn't know anything, and I'll ask questions. So if you guys start using lingo, you're gonna I'm gonna throw my hand up. So first, the very first thing is, what's multifamily? I know that seems really easy because we're in it, but what is that?
Yeah, that's actually a really good question, because half the time when I'm talking to people who aren't really aware of what this business is, and I say I invest in multifamily, they're like, oh, like duplexes and triplexes? That's a very common first thing people say. So I think it's really important to define what the heck we're talking about here, which is multifamily, meaning larger apartment buildings, big stuff, not a duplex, a triplex, or a quad. So
yeah, technically it starts at 5 units, and goes up from there. But yeah, we like to dabble in the higher numbers.
And why does it start at 5? It's hard because I don't feel like there is a really set definition necessarily. It's kind of a moving target.
When you're talking about appraisals and lending.
Sure.
I mean, that's the way I look at it is, when you're getting a commercial loan on something, they call it commercial when it's 5 or more. And same with appraisals. When you're getting appraisals done, if it's got 5 or more units, they start to look at income. Whereas if you have a duplex or a triplex, the income is, from what I understand, not really factored in. It's pretty much just comps.
Yeah, I think that's pretty much where the definition comes from, as a lending institution, more than it does from our sector per se.
Mm-hmm. Yeah, I guess for me, from the lending perspective, I've always heard residential and commercial. Residential being single family all the way up to a quad, and then at 5 units and above, now we're talking about commercial loans. But I've never necessarily heard the lenders specifying and saying that's multifamily or not multifamily. So that's for me.
Well, yeah, I think that's part of it. When I talk to brokers, and not larger multifamily brokers, but just sort of people in real estate in general, when I say the word multifamily, a lot of them default to duplexes. So I think a lot of those people, when they hear multifamily, they're like, anything that's more than just one unit, one house, if there's more than one occupant, basically, that automatically goes into multifamily, which is true. I mean, literally it's multiple.
To say the least, it's kind of a fluid term, I would say.
Yeah, and that's what I'm trying to get at here, is that it is a little bit fluid, but for the context of this conversation and the type of investing that we do, we're talking about commercial properties that are 5 units or larger. For Rodney, you have a couple 100 unit complexes, right?
Yes.
And then Dan and I, our largest is 32. So there's a range there.
So yeah, multifamily. I think we've got that defined. People should understand what the heck we're talking about from here on out if we use the word multifamily. Now the elephant in the room, right, is what the heck is a syndication? I think that one, especially to a lot of new investors, that's an intimidating term. Because up until I got into this business, the only time I heard about, the only time I remember hearing that term used was like syndicated TV shows, like something goes into syndication, like that. I'd never heard of it in reference to real estate up until recent years. So I think it's kind of a newer thing, and it's probably not on a lot of people's radar unless they're out there looking for it. So what the heck is it?
Yeah, and a syndicate
know?
is really just where people pool their money. So you have a collective of multiple entities because typically investors come together as entities and pool their money to buy an asset. And so that's where the term syndication comes from.
Yeah, so actually, Rodney, can you give me screen share ability? I'm going to share an infographic here. We can kind of walk through it that we designed, just laying out what is a syndication, who are the individual players in it, so we can kind of talk through what the pros and the cons are as well.
Let's see. I thought that you should be able to screen share.
It says host disabled participant screen sharing.
Oh,
you put the child locks on me. I've been child locked.
He does not trust you.
I mean, rightfully so.
Yeah, we don't know what you're going to throw up on that screen, so
yeah, I'm not sure either. So yeah, just
normally on the list out here, it says that to allow share, but
can you do like an interpretive dance of what the infographic is? Just to
try that now. Ooh. I just said multiple people can share.
There we go.
All right.
All righty, here we go.
So the other thing that we should mention somewhere along in here is JV, because that's another type of a collective purchase of a real estate. Now that's not what we do here, but in case people have questions about, well, I heard the term JV, and that's a joint venture, which is different than a syndication.
Yep. Yeah, and we can get into the nuances of the two after we lay the groundwork here for the syndication, because I think that it'll make a lot of sense once we go through this. But can you guys see the screen? Am I dominating everything?
You are dominating everything.
Okay, so can you see my mouse too? If I gesticulate wildly here. Okay, so
I feel like this graphic is so good we don't even need to be here.
Okay, everybody just sit silently. We're going to just have a moment of silence. You just digest this. Okay, so the syndication is, like you guys have already mentioned, there's a lot of ways to syndicate. You could syndicate a candy bar, you could syndicate a boat, you could syndicate a racehorse, a spaceship, whatever. Like sky's the limit.
Alpaca?
You could do an alpaca. Yes. Okay. Yeah. You can syndicate pretty much anything. The idea is that a group of investors are going to pool their resources, and the resources being time, knowledge, money, to buy something. In this case, we're buying a large asset that we're going to split the profits. And the reason that we do that is because on our own, we might not be able to go out and buy a 100-unit apartment complex, right? And when we're talking about these properties that cost millions of dollars, one single investor might not be able to go and get it. But there's a lot of benefits to multifamily investing that we'll talk about in later episodes. But this is the groundwork. That's the syndication. Now there's two different entities within a syndication. You have your passive investors and you have your active investors. So let's real quick talk about the active side of things, because that's close to home for all of us, because we're all active investors.
Is this where we're supposed to say something, Dan?
Yep. Something compelling and provocative and insightful.
You want me to talk about what the active investors are and what they do? Okay. So yeah, the active investors, otherwise known as the general partners or the GP team, could be one person, it could be multiple people. These are basically the people that are taking the majority of the risk. They're doing essentially all of the work. They're going out, they're finding the deal, they're finding the lender, they're negotiating with the seller, they're finding all the investors and coordinating everything. And then most of the time, they're also either someone involved or entirely involved in the actual operations of the asset after it's purchased. If you guys watched our, I think it was last week or maybe it was the week before when we talked to, oh geez, I forgot the name of his company.
Patrick Duffy with
Tactical assets.
Tactical, that's right. Yeah.
Yep.
Sometimes the general partners will outsource, the asset management element to someone else. But anyways, for the sake of simplicity, basically the general partners, the active investors are the ones that are actually doing all the work, putting in all the time and taking the majority of the risk. And then that leaves the limited partners or the passive investors.
Boom. General partner.
Yeah, the general partners put up the loan application fees, pay for due diligence. All of the upfront money costs are the active the active investors, and the ones that actually close the deal. Passive investors are the ones that they're the ones that bring capital to the table. That in addition to the active investors, so the active investors and the passive investors will pool their money. The active investors are the ones that actually pull the legwork into making the syndication happen.
Mm-hmm. Yeah, I think one other thing to note too is that usually the general partner on the deal, this is their full-time job, is putting together deals. It's this is their thing, this is their business, and typically the limited partners, the passive investors, the name implies it. They're investing money, but they have other stuff going on. They've got their own careers. They're not out there hunting for deals. They're not putting their time into this. So the GPs really this is their thing. This is what they do.
Yeah. So every deal is going to need time. Oh God, that's white. Really? Okay. It's going to need time, knowledge, and money, right? And so the passive investors are bringing the money, and active investors, by and large, they might bring some money as well to the table to put some skin in the game, but they're bringing the time and they're bringing the knowledge. And so here at this roundtable, we are all active investors. We're operators. We spend a lot of time networking with other industry professionals, the brokers, the lenders, to make sure that we're getting deal flow. And then that when we get the deals, we can bring everybody together and execute on the deal. And then once we have it, then we spend the time and the energy to run and manage the deals. And then we handle the exit. So we're doing all the work, and we're providing the time and the knowledge necessary to run a smooth operation. And then the passive investors, it's really simple. They just bring the money, and then you sit back and you collect quarterly checks in the form of cash flow checks, or however it's going to be structured. And so the passive investors, it's a great role if you love your job, you love what you do, you're not really interested in learning the ins and outs of real estate. Because as we talk about multifamily of the type that we do, there's a big difference between being a really good operator and being a really bad operator. If you're a really bad operator, you're going to lose a ton of money. It's going to be problematic. And those are the type of people we like to buy our properties from. But if you're a really good operator, the sky's the limit. You can realize great profits. But it's very different than small single family properties where, you could go buy a couple of those and they put some property management in place and they kind of run themselves. It's not a big deal. You're not going to make a ton. You're not going to lose a ton probably.
So why wouldn't let's say someone realizes that real estate's awesome. Why wouldn't they want to go and, if you don't have to be that great, why wouldn't they go buy a house, a single family rental, or maybe a duplex, as opposed to being a limited partner on a larger deal like this? Am I jumping ahead, or is this?
No, I think that's a great question, because as we talk about multifamily and syndications, it is a logical question. It's like, why don't I just go do this myself?
Yeah.
So Rodney, how do you handle that question? Do you get that question ever as you're talking with potential new investors?
So I think once a person understands the large multifamily aspect of it, they understand that there are a lot of moving parts. And I think this is where a lot of investors get in, because they look at a single family house. It's something that they know, they live in one, and there isn't as many moving parts. You can approach a real estate agent, you can get a loan for a house and you can start renting it. And, you know, you might have to fix a toilet. You might have to deal with a tenant, or you can pay a management company to do that kind of thing and reduce your profits. But I don't think that most people that I've run into have asked me that when it comes to buying 100+ unit apartment complex, because they understand that there is a complexity there that they're not really willing to deal with. And if they are, well, then they're seeking other questions. You know, how do I get involved in something like this? And then we can steer them to programs that, you know, all three of us have, you know, participated in. And so, yeah, I don't really get that question that often. And I think it has to, you know, a lot to do with who we're talking to, right? Because we're talking to investors that are already pretty savvy, and they may not know all the ins and outs of a syndication, but they understand that there is a passive investor role, and that's exactly what they're interested in, because they're not interested in the day-to-day operations.
Yeah. Well, I think I do get, I don't know if I get that question posed to me a lot, but I have that conversation a lot. And usually people aren't asking me, you know, hey, why don't I just go buy a house instead of investing in one of your deals? Usually what happens to me is I run into guys who are really into the real estate concept, the business model, the idea of it. Mm-hmm. And they're a lot like me when I first started, where they just want to do everything themselves so they can, you know, be the one in control and take all the credit. And they just really want to do it. And, you know, my advice to them is always the same. Like, you know, that's great. If you want to do it on your own, have at it. If you love it as much as I do, then, you know, I wouldn't have had it any other way. But when it comes to deciding whether or not to be a partner in a large deal versus going out and getting, you know, a single family house or duplex or triplex, my response is always just, well, you know, run the numbers and see what's going to make you more money and see what's got less risk. And if you find a single family home that makes you more profits with less risk than a larger syndication, then by all means go do it. You'd be dumb not to. But, you know, 9 times out of 10, or I'd say 9.8 times out of 10, when you run the numbers, spreadsheets don't lie. You know, it's pretty black and white when you're doing math. That's what I love about it, is it's like the numbers just make sense. You're making more money and taking less risk when doing a larger deal. So, you know, but there's plenty of people out there that just really don't like the idea of investing in apartments, buildings. They'd rather just own a couple houses, and, you know, their goal isn't to make as much money as possible. They just kind of want to be like a landlord as a hobby. So, you know, for those people, great. Have at it. But if your goal is to create wealth and make as much money as possible and minimize your risk, then just run the numbers, and that'll answer the question for you. That's usually my response.
The key word. Oh, go ahead.
I was going to say, I think you bring up an interesting point, Dan, about the risk. And I would say that a lot of people look at single family housing as less of a risk because, you know, like I said earlier, it is a familiar thing, but the other thing that you said, and if you look at the amount of money that you put into a single family house versus a syndication, and then you look at the return on that, and I don't know too many single family houses, unless you really buy right, that you can double your money in 5 years. There are the deals out there. I'm not going to say that they don't exist, but being in a syndication, at least the ones that we try and buy, underwrite out to where our goal is to double an investor's money in 5 years.
Mm-hmm. Yeah, that's exactly why I tell people to just do the math for themselves, because, you know, I could say it all day long, and, you know, I kind of do, but at the same time, I'm a little biased because, you know, I invest in these deals. But like I said, the math doesn't lie. So if someone does the math themselves and they see, oh, if I get this house, it's, you know, if my underwriting's on point, you know, it says I'm going to make, you know, 10% a year, best case scenario. And then there's a lot of, you know, inherent risks there. You're relying entirely on market appreciation. You don't have the ability to really force appreciation quite as well with single family as you do with multifamily, which we'll get into maybe this episode, maybe next one. But you know, when people do the math, the numbers almost always will point to you know, a syndication being a less risky and more profitable deal, unless there's that oddball situation where you just steal a house. You know, you just find some ridiculous deal, you know, 50 grand for something that's worth 200. If you find something like that, I mean, by all means, take it all day long.
Oh yeah, absolutely.
But that's, at the same time, that's not really a scalable model either. If you're looking for these unicorn deals, what, once every 5-10 years you might find something. You know,
the key word in all this that you've mentioned a couple times there, Dan, and I want to really draw attention to it because I think it's actually the most important aspect of answering this question of should you be active? No, but that's going to be, I have a pin in my notes right here to come back to that one because it's also very important. It's the idea of the goal. What is your desired outcome? What do you want to achieve, right? When somebody comes and says, hey, I want to get into real estate, I'm thinking about going to buy this single family house. The question to ask is why? Why do you want to get into this industry and do that? Is it because you want to replace your day job? You want to leave it? You want to find another avenue and you want a means to quickly accelerate your cash flow situation so that you can start living a different life? Then that might be a really great option. Go on the active side and you can do that. But if you love your job, if you aren't interested in being a landlord, and you like the idea of collecting cash flow, then it doesn't make sense to go out there and do it on your own. And so, Dan, you pointed out, like, for you, your personality, it made a lot of sense. Like, you love what you do, you're doing it full time. Like, it makes a lot of sense for you. It wouldn't make sense for you to be a passive investor, right? Whereas somebody else, given their life situation, it's going to be completely the opposite, perhaps. Like, I have family I want to spend my time with. I don't want to be dealing with all the stress and the rigmarole. I have capital saved up in a 401k. I've been doing this for a while. I just want that money to go work for me so that it can, you know, start supplementing and building some generational wealth. So I think starting and understanding what's the desired outcome and then working back from there and saying, is this the right path for me or is this the right path for me?
Yeah. And that changes too. I've seen that in several people over the years where they start out you know, really active in real estate. And then as they get older, they start gravitating towards becoming LPs because, you know, they've accumulated a good amount of wealth. They're not really concerned with, you know, trying to double or triple their money every year, every 2 years at this point. They're more concerned with creating as much time in their life as possible. And they're perfectly happy with, you know, 15 to 20% return every year, as opposed to going out and trying to make, you know, 50% doing everything themselves. And, you know, so I've seen a lot of people kind of change as they age and priorities change. So
I think a lot of active investors end up down that path. You know, they're very active and then they transition as they move along. So they can
let the young bucks do it who have all that energy going hunting for deals, walking properties.
Yeah, because let's be really clear here, is like being on the active side is a lot of work. Like you're constantly grinding, going out there and trying to get new deals in the pipeline. When you have the deal in the pipeline, now you have to execute it. You have to get investors on board. You have to do all the due diligence and get it across the financing table. And so it's not easy. Like it's a very particular personality. And by and large, I'd say the very entrepreneurial personality. If you're the type of person who doesn't work well for others or in an environment with like a lot of structure, then this can be a really great path for you. But cool. Yeah. I put a pin in the risk conversation because we keep talking about low risk, in reference to multifamily syndications. But at the same time, we're also like single family is risky, blah, blah, blah. So let's really nail down, because here on the graphic, we have on the general partner side, risk, 9 out of 10. That's a lot of risk. Limited partner, 1 out of 10. Okay, and let's qualify this real quick. When we talk about risk in this context, we're comparing it against every other investment type, which is you always run the risk of losing your initial capital. That's always a risk, right? And so that's our baseline of 0. Beyond that, risk that we're talking about here is you know, accountability to the lender or, you know, to legal authorities if something goes wrong. So let's really break that up real quick.
And accountability to your limited partners too.
Yeah, reputational risk.
Yep.
That's huge.
So where do you want to start on that
Well,
spectrum of risk? What?
let's compare the difference. Why is a single family risky compared to a multifamily? Why would the multifamily not be as risky for an LP specifically?
Well, I don't know if it's less risky. It's perceived as less risky, but there is some management needs to go on there. Of course, single family valuation is tied to comps in the neighborhood. So if and this is a huge part of the risk, is if we look back, and I know that, right now we're still in a bullish market, even though everybody thought that the market was going to change, with the COVID. Right now, things are showing to be pretty steady. Lenders have tightened their standards up a little bit, but they're starting to loosen those up. And if we look back at like 2008, for example, when the housing market crashed, multifamily fared that whole thing really well. And, in comparison to a lot of other asset classes. And because it's tied to the NOI, it's not tied to, how pretty your neighbor's house looks and what the one down the street sold for the last month. So that's the largest difference there in the risk. I mean, if you have risk in how you're running the place, there's more moving parts when it comes to housing an apartment building than there is a single family house. But there's risk associated on both of those. If you run either one poorly, they're going to have deferred maintenance, and you're going to start losing money because you're not going to be able to maintain tenants. But as far as risk and what would you call it, steady value, multifamily is just completely superior to a single family house.
Anthony, could you repeat the question again? I had someone walk in my office when
unacceptable. Yeah. So the question right now, like I want to spend a little bit of time talking about risk, specifically through the lens of a passive investor in a multifamily syndication, because we've talked about how if you wanted to go buy your own single family, there's higher risk involved in that than if you were a passive investor. And I really want to nail down why that is, and being very clear of like, this isn't, there's very specific reasons why we can point to that.
Yeah. Well, I mean, if you go and buy a house, let's say it's $100,000 house, and you go and put 20% down as a down payment, and this is going to be an investment property, you're going to rent it out, and then something happens and you just screw the whole thing up. You're out your 20 grand, and then you also owe the bank, whatever they can't get from the house. So you're on the hook for 100 grand, which is a lot of risk. You're putting up 20, but you're controlling a $100,000 asset. And if you drop that ball, you're the one that's got to make it good. You sign the loan, you put your name on there, and they're going to come after you. If you're an LP in a larger syndication deal, if the world explodes and the deal goes completely horribly, you could lose what you put in, but that's it. The GP on the other hand, is kind of in the same situation as that single family home owner, right? They're the ones who are kind of, signing on to the loan for the bank. So, they might be putting in, 5, 10, 15% of the capital, but they're taking essentially all the risk because, in the last deal we did, it was an 80-20 split between GPs and LPs. We put in 200, LPs brought in the other 800. And but we're on the hook for that $2 million loan. So we put in 200K, but theoretically we're risking about 200. We're risking about $2 million, right? Because if the deal goes to hell, then banks coming after us, not the LPs. So that's a pretty big difference between the two. As an LP, you could, if you invest with a bad operator and you do no due diligence and something goes completely horribly wrong, you could lose all your capital, but you're not going to be filing for bankruptcy because banks are trying to seize your assets. So that's a pretty big difference. And then I think I heard Rodney mentioning it as well when it comes to the valuation piece, which is huge. You have control over the value, which is enormous. In the single family home market, if the value of the house goes up, great. If it goes down, that sucks. And you just have to kind of ride that wave, which, happened to you, Anthony. You had it was either duplex or triplex. And, luckily that wave went your direction, but you mentioned on that
gone the other way.
You did. Yeah, it could have gone the other way, but you made a decent amount of money pretty quick on it, but you're like, it just didn't really feel that great because it's like, it didn't do much. It just happened to be a good little chunk of the market there. And it could have easily gone the other way and it's completely out of your hands. Whereas with the multifamily, like Rodney said, the value is based on the NOI. And as the business owner are controlling that, you're, controlling the income by determining what the rents are and how effectively you market the property, and you're controlling the OpEx. So, your ability to manage is going to directly influence the value of that property, which is why, like you mentioned, apartment buildings did well in the real estate crash of 2008, right? Because the value is based on the income, not on, what Joe's house down the street sold for. So.
Yeah, and that's a really big topic. I think probably makes a lot of sense to tackle in one of the next segments, whether either next week or the week after, because we could spend an entire time talking about NOI, expenses, revenue, and how we come to these building valuations and what leads to that stability that we'd like so much. But one of the other things then, kind of moving from this then and back into the infographic is the interplay between, let me see if I can pull it back up here real quick. Boom, here we go. The interplay between time and capital. It's kind of an inverse relationship here for the general partners and the limited partners. The general partners putting in all their time and their energy, the limited partners, there is work involved at the beginning, vetting and finding operators, and then vetting the deals and educating yourself so that you understand, like, how do you know if it's a good deal or not? And so this one is a little bit low, like there is a little bit of time and energy, but once the deal is kicked off, you have that baseline education, you're good to go. And then as we talk about the capital, like this is where the big risk really comes in for limited partners. Like you put your capital in, and there's always a chance in any investment, there's no guarantee of returns, right? So there's always a chance you could lose your money, but you're not on the hook for more than that with the bank. Or another aspect of the risk that I really want to talk about is we're syndicating, which is a security under the guidance of the SEC. And so there's very strict guidelines. And as Rodney pointed out earlier with the joint venture, there's a big distinction between a syndication and a joint venture and what all that means. So let's break that apart real quick and talk about why it's a security, why that's actually kind of a good thing for the limited partner, maybe not the best thing in the world for the general partner because it means more hoops to jump through, but ultimately it works out to be the best for the industry at large.
Yeah, when it comes down to it, if there's someone who's doing work to produce profits for somebody else who's not doing the work, that's pretty much what's going to make it a syndication. A joint venture implies that everybody in the deal shares in the risk and shares in the management or the operations. It implies that everyone in the deal's active to some extent. There's a lot of nuances there that you can probably try to finagle with if you want to try to get tricky. But the bottom line, if there's someone who's doing the work to produce profits for somebody else and they're relatively passive, that's really what's going to differentiate things from a JV to a syndication.
Yeah, another huge difference between a JV is if the three of us bought a building together and we did a joint venture, we would all own 33 1/3% of that building, or however we agreed to split it up. But the three of us would be on the deed, all three of us. Syndication, on the other hand, the deed is held by the entity that is purchasing it. And like you said, Anthony, that there are shares or units, depending on how they're defined, that are sold to the passive investors, and they're basically buying what's like a share in that entity that purchased that building, and they have no say in the management. It's the responsibility of the operator to run it, and they don't participate in the ownership like they do in a joint venture. And so that's the big this distinction is like you brought up, Dan, is the level of involvement. But from a legal standpoint, a JV is a part owner, whereas in a syndication, it's all the general partners that are named on the entity that purchased it, and all the LPs are just bringing the capital and buying, quote unquote shares. They're not shares, but a lot of people call them units.
Yeah, I'm really glad you segued into that direction, because there's some nuances there that we hadn't really addressed yet, which is when we go into this syndication as a limited partner, you're not actually buying, you don't own the building, right? You own shares of the LLC that owns the building. And the really big nuance there then is that the general partner has all the control. They're making the day-to-day decisions about how to operate the building, and when to buy or when to sell it. And there might be some clauses in the contract that give you voting rights or some levels of control, but by and large, your control is going to be very low as a limited partner, and the general partner is going to have all the control. And this is a good thing, actually. If you think about it, you don't want really liberal voting control in one of these syndications. And the reason is you spend all your time vetting the operators that you want to work with. So if you decide, I want to work with Rodney, you're going to spend a lot of time vetting Rodney. You might do a background check on him. You might talk to some other professional referrals, his investors that he's done deals with, and say, okay, I trust Rodney and his expertise. And that's what you're going into the deal with. Now, if all the limited partners in this deal have voting control, then suddenly all these other maybe 20, 30 other investors that you don't know and that maybe aren't industry professionals have the ability to make a decision that impacts your investment. That's not necessarily a good thing, right? So you are really, when you come into these deals, you are putting a big vote of confidence into the general partner that you elect to work with. And so the vetting process is super critical.
Mm-hmm. Yeah, I think kind of tying that back to the risk conversation we're having, on the infographic there, we had a little number 1 as far as time that the LP puts in.
Mm-hmm.
That little number 1 is basically you vetting the operator and vetting the deal. And that little 1, as far as time, is where you can effectively reduce your risk substantially. I mean, that's where the risk is. You either vet your operator into the deal and you reduce your risk down to, pretty much nothing, or you just find someone, they, maybe you follow them online, they seem really cool, and you just jump right in. You don't read the docs, you don't check references or anything like that. You just jump in. That's really where your risk is as an LP, is if you don't do your homework on the operator and do your homework on the deal. So
absolutely. This strikes me now is that the risk itself is almost never in the deal inherently. It's always in the operator, because a good operator can take a moderate deal and make it great. They can do great things with it. But
or a
bad operator,
deal.
right? Yeah, it can even take a crappy deal and make it pretty good, probably.
Yeah.
Where like a bad operator is going to ruin a great deal. So the risk isn't really in the deal itself; it's in the operator you're choosing to work with. And so it's hard to put into overstating just how important it is to make sure that you're getting into bed with the right operators, because these deals last anywhere between 3 and 7 years on average. That's a long time to be stuck in a relationship with somebody that after 6 months you realize, I don't like the way this person operates. I don't trust them anymore, or they're not communicating clearly with me. You're going to be in for a really long investment.
Yeah, because this is an illiquid investment. It's not like buying stocks where if all of a sudden you read that Apple is going to quit making iPhones and they're going to change the name to ePhones, and it just irritates you, so you're going to sell all your Apple stock. It
Horrible
doesn't
idea.
work that way. There are some clauses in there where you might be able to sell out, but as a general rule, it's an illiquid investment. And so, to your point, you're going to be there until the property sells. So knowing your operator is super important, and being comfortable with the way that they run their business, and then underwriting the deal so that you understand with the business plan that the operator is proposing.
And also just have a, spend a few $100 and have a lawyer take a look at the private placement memorandum, because that's a pretty comprehensive doc that gets signed when you get into these deals. So I think it's well worth it to drop a little bit of money to have someone who's 100% on your side tell you whether or not the deal is structured in a way where you're protected. Make sure there's nothing crazy going on in there, because those are 30, 40, 50 page documents. And even if you do read the whole thing, it's a lot of legal jargon. So it'd be very wise for limited partners, especially new ones who are getting into this stuff for the first time, to have a professional, have an attorney take a look at those documents. Just make sure there's nothing weird in there saying, I don't know. You never know what someone might put in there. Usually these deals are pretty straightforward.
Yeah. An example of something that might be in there that you really could maybe take you by surprise is the capital calls, right? And mandatory capital calls, where if you're not paying attention for it, the operator could slip it into and we're getting really high level, and I think this is probably warrants diving into on its own, and like the team members that you have.
On that.
Yeah,
we didn't talk about what a PPM was.
Exactly. But for instance, yeah. So maybe let's just leave it there. But just know that there can be really disadvantageous clauses within that PPM, and we can talk about what some of those specifically are in one of the coming episodes in the next couple of weeks, because I think we could dive deep into it.
Yeah, I think the bottom line for people watching this is basically the most important thing is to vet the operator, and vet the deal secondarily. Vet the operator. That's really your big thing. Make sure you're working with a good group, and then to make sure the deal fits your investment parameters. And then last but not least, and actually when we were talking to our syndication attorney, he said, the PPM was like the least important piece, right? The operators really worry about, and that was our syndication attorney telling us that the PPM was like the last thing you should worry about. Like, the operator is the big thing. Make sure that person is going to be a good fit for you.
And just to clarify for people, the PPM is called the Private Placement Memorandum. It is the big legal document that everybody is going to sign to make sure that we're all on the same page going into this investment. So it's laying out the rules. And so that's when we're saying PPM, that's what we're talking about. But yeah, that was actually really surprising. Like, our syndication lawyer, we threw him a softball. We said, what's the most important thing for a passive investor to be aware of and pay attention to? And we thought he was going to say, for sure, the PPM.
Yeah.
And instead he's like, you need to vet your operator. You need to make sure that you like and trust them, and that you're committed to that.
I like that answer though.
Well, it's the right answer, right?
It's the right answer. And I just wasn't,
didn't expect
I don't think the PPM answer would have been incorrect necessarily, but it was nice to hear him say that. So
yeah, I agree.
Yeah, it's a document that the investor should absolutely be aware of, and should definitely go over and have his attorney look at it. Like you were saying, Dan, we don't want to dismiss that, but the importance in making this whole thing work is the operator. If the operator is not doing a good job, the PPM can say all kinds of great things, and it doesn't do anything for you.
Yeah, I think either Zach, our lawyer, or Anthony said it. I can't remember which one, but the PPM is basically like the rules of the game. And just because they're there doesn't mean that the operator is going to follow them, right? So even if you've got a really great PPM with like everything structured perfectly for the limited partner, if you're with a shady dude, it doesn't matter.
Doesn't matter.
So
it may give you some legal ground to stand on, but
you don't want to get to that point though.
You're still assuming risk. It's an investment, and the PPM should spell out that this is risk capital, that you should be able to be in a position to lose it all.
Mm-hmm. Yeah, definitely don't bet the house on it.
Yeah. Exactly.
So let's
intended.
No. All right, so let's talk about the last aspect, I think, for this evening is, and one of the reasons that we like multifamily.
That's the best part.
It is the best part. So let's talk about this. Why do we have it as 3 for general partners and 7 for limited partners? Let's really dive into the profit side, because that's, at the end of the day, that's what we're all here for, right? Like, we're investing our money to put it to work for us, and we want it to earn a good return.
Mm-hmm. Yeah, well, I mean, if you look at the capital row, or whatever you want to call it there.
Here you go. I got this.
Thank you.
Yep.
If I point at it, no one can tell on the video. So, if you look at the capital chunk there, the limited partners are putting in the majority of the capital. So it makes sense that they'd be pulling out a majority of the profits, right? Mm-hmm. Makes perfect sense. Yep. But yeah, I mean, like I mentioned before on our last deal, we had an 80-20 split with our LPs on the last deal. So we put in 20% of the capital, did all the work. They put in 80%. And that split was consistent, but different groups and different deals are going to be structured differently all the time. I've seen 25-75, I've seen 70-30, how there's probably 50-50 splits out there.
There actually are 50-50 splits.
Yeah, probably Grant Cardone.
Yeah.
Gotta mention him once.
Uncle G.
Yeah, we almost made it through, man.
He didn't make it through, did he?
This is almost a full hour. It was crazy. I was like, man, we're going to get there.
Yeah.
Yeah, so this 7 and this 3 it's just reflective of one of the most common splits when you look at syndications, which is the 70-30. As Dan pointed out, on our last deal, we did an 80-20, so that was even more favorable towards the limited partners. But
We're
really,
nice
we are really nice guys. I'm glad.
And it's a really good deal, so it's just a lot of money to go.
There's enough meat on the bone, so it didn't matter. Yeah.
We normally run a 70-30 split. For our deals.
Okay.
Although the last deal we ran a 25-75 split. And we did that because we just felt like the returns were not there for the investor. And so we reduced our side of it to give more profits to the investors.
Mm.
Yeah, that's something you want to be on the lookout for as a passive investor is that type of mindset from the operator. When you see guys like Rodney who have the long game in mind, and they're not trying to make as much money as possible today, they're more so trying to build a successful business for the long term, and they're okay making less on this deal, giving more money to the investors for the longevity of the business and creating wealth for people. Like that's a big red flag that you're working with a good operator when you see that type of stuff. So
red flag.
That's a good flag. What's the good flag? Green one.
Probably green.
Dan doesn't do sports, but
I know. I don't know my flags.
Wait a minute. It was really sounding good there, and then you said red flag.
I mean, it.
He juked us. I was like, whoa, red flag.
Red can be good, right? I mean,
not
Christmas.
Usually. I mean, Valentine's Day, maybe, but
anyways,
the color of passion. Okay, so last thing that we didn't touch on here, and we can hit it real quickly from a high level, are the tax benefits. And this is actually one of the only
good stuff.
This one's interesting because it's the only one on this entire sheet where the general partners and the limited partners both get like very high marks simultaneously. Usually one is getting a high mark, the other is getting a lower mark. But here, it's both 9 out of 10. Both parties get to benefit from all the tax breaks.
Yeah, there is this wonderful thing called cost segregation. And it's where the government has allowed us to accelerate depreciation on certain aspects of the property. And when we buy a property, we bring a cost segregation company in, like Madison Specs or any of the other ones that operate out there, and they come in with a team of engineers and look at all of the different parts of the building, and the government has structured the tax schedule so that we can accelerate depreciation on a lot of those components and recapture a lot of that depreciation up front.
Hey, Rodney, what's depreciation?
Wait, no, I got my idiot hand
Oh,
up.
sorry.
What's depreciation? we take it for granted because we live and we breathe this world. But to the general person that's never heard of this stuff, depreciation is like, well, I have no clue what that is.
Well, unless Dan, you probably have a better explanation. Now, I can try and explain it because I know what it is.
Yeah, I can do it.
I know that that
I've done it a handful of times, so I can rattle her off.
So I think Dan's going to be a better person to explain this than me. So you go for it.
All right, here we go. So I think most people have heard of depreciation when they are talking about like cars or something, right? We know that as soon as we drive our car off the lot when we buy it, it loses value instantaneously, right? Essentially, depreciation is the opposite of appreciation, which we've talked about a bunch here. It's the value going up. So as something loses value over time, that means it's depreciating. And typically,
it sounds like a bad thing.
You'd think.
Mm-hmm.
So, the logic is the building's going to wear out over time, right? And the IRS wants to compensate investors for that theoretical loss of value over time. So by default, apartment buildings are going to be depreciated over 27 and a half years. So what that means is every year you take the value of your building less the value of the land and divided by 27.5. And every year you get to deduct whatever that number is off of your taxable income. Because theoretically your building lost that much value that year through depreciation. So it's like an expense that you get to write off, except you never have to write a check to anybody. No money goes out the door. It's just a theoretical, it's called a phantom expense. So it's an expense that only shows up on your taxes, right? You never pay anybody for it, but when you file your taxes, oh, look, this expense line item goes here and it knocks down my taxable income. And then like Ronnie was saying, there's something called accelerated depreciation. So instead of taking that value of your building, dividing up over 27 and a half years, you get to take all these components in your building and have them depreciated at a quicker rate, because your stoves aren't going to last 27 and a half years. Your windows aren't, your carpet's not. That stuff's all going to wear out all those things have different lifespans on them, basically. So what these cost segregation specialists do is they come in and they take all the components of the building and they throw them into these various buckets. I think it's like 1 year, 5 years, 7 years, 10 years, 15, 27 and a half.
Mm-hmm.
And they say, okay, all these appliances, they're good for 5 years. So we'll put the value of those in this bucket. And then what happens is that value of the building gets scrunched up into the first part of the life cycle, usually the first few years. And all of a sudden that depreciation expense line item gets really big. So all of a sudden your taxable income gets really small. So even though we are, buying assets where we can go in and fix them up and make them appreciate, they're simultaneously depreciating on your taxes. So the value is increasing, but when it comes time to pay your taxes, oh, we just lost a ton of money. So
bummer.
It's not a loophole. It's just one big giant incentive that the IRS has created because they want people to invest in real estate. You're creating housing for people who don't have the ability or the desire to go out and buy a house, which is extremely valuable to society. Mm-hmm. So when the government wants you to do something, what do? They give you a tax credit or some sort of tax incentive to make you do things that benefit society and the country. So
mm-hmm. That was a fantastic explanation.
And we're done.
All right, guys, that's everything. Cool. I think
hopefully that makes sense. I think we should throw in some links to maybe some other videos that we've done where we've gone into a deep dive on some of these things. We've done depreciation. We've done a lot of stuff we've talked about. So I think we should throw some links into this.
Yeah, because we didn't really get into cost segregation, and we don't have to explain how the whole thing works, but the passive investor definitely wants to know about cost segregation, because that is a great thing. I was trying to find where I have an example of.
I got a video that I did on it. So
yeah, we can link. Yep.
We'll link that in the show notes.
Yeah, I don't have anything really to add on to the tax side of the conversation from a high level. I think you did a good job of explaining that for the general. Just know as a passive investor, the tax benefits can be passed on to you as well. So the money that you're earning every year in the form of cash flow distributions, which we'll talk about that in a later episode and like all the ways that you can get paid. Well, that can be that's going to be offset then by the depreciation. So you're not going to necessarily be paying as much or maybe any taxes on that. And then we could get to some nuances too if you're a real estate professional and how you could even offset other earned income from other sources. So
yeah, I think one last thing to tie the bow on the tax piece is that's really the thing that separates investing in real estate from a lot of other things. Because if you're making 15 to 20% in a syndication, that's good. That's great. You don't want to discount that. But a lot of people will say, oh, on average, the S&P goes up, 12, maybe 15% a year over a long enough time horizon. Right. But then you factor in taxes. Okay. You're going to be paying capital gains taxes on any profits you make invest in the market. However, on syndication, we've got that little depreciation thing slipping in there. So let's say you invested 100 grand into a deal and over the course of a year, we sent you cash flow checks that totaled 20 grand, right? At the end of the year, you get a tax doc that says, once we factor in depreciation, you actually only made 10 grand, right? So you're only going to get taxed on half of it. So once you factor the taxes in, it's no contest between anything else, unless you're drilling for oil. That's like the only other thing that can.
So I can share with you, I did find this, and this particular individual, and this form is redacted, so you're not going to be able to see who it is, but this is their K1 for $100,000 investment. And this is their first K1 after we did the cost segregation. And this person was able to write off on $100,000 investment, $77,865. So
how much did they get paid out in cash flow that year?
This individual here, this property was purchased in December, and as long as you have the cost segregation, everything done prior to taxes, which is March 15th, then all of that gets counted in the prior tax year for this one. So this individual has not received a disbursement yet.
Okay.
But just because of the cost segregation, he has a negative 77,800 that he can apply towards his income to offset any income he has. And if you don't use it, of course, you can carry it over to the next year.
So that's basically $77,000 of taxes. That's basically, I don't know how long it's going to take him to make 77 grand in your deal. If you invest 100 grand, maybe, 3 years or something.
Yeah.
Basically, he's not going to have to pay taxes on stuff. Now, obviously, we should preface this. None of us are CPAs. If you have any questions about your specific tax situation, always talk to your own CPA. But just to illustrate the concept, this is what separates real estate from everything else, is being able to make money, and then when you go and file your taxes, have it say that you lost money, and thus not have to pay income tax on stuff.
So if you offset that with the first 3 years of returns, depending on what they are, at this point, he's not going to make any money theoretically until the third year. But I'm glad you did mention about the CPA, because we definitely want to make sure that we're clear on that you need to, and your tax consultant is the one that you need to be talking to, not us. And just like with any of the legal stuff, you need to consult your attorney on that.
Yeah, we'll talk to you about the profits. Your CPA can talk to you about the taxes. I think that's a good deal.
Exactly.
Yeah. And just to cover our bases, because you did mention Grant Cardone, hashtag please don't sue us. So
I feel like if you did sue us, that'd be really great marketing. So
I would love it. It'd be super cool.
let it happen.
All right, guys. So this is, I think, a good place to kind of wrap it up. This was a good conversation for starting, for the beginner's guide to getting into passive investing and apartment syndications. Next week and the week after, this is going to be a 3-part series where we just keep diving deeper and deeper into some of these concepts and flush them out a bit more. But just to kind of wet your whistle for next week, I think we're going to talk about how the value add model actually works, why it's so powerful, and how you can add millions of dollars of value to a property in the span of just a couple of years. And once you see how those numbers really work, it becomes a light bulb moment where you go, whoa, this is very, very powerful. So look forward to that.
This is one of my favorite
I'm excited.
parts is the accelerated appreciation or forced appreciation. It's can't wait till next week. It's awesome.
Yeah. It's really hard to overstate it. It's like once you learn about it, it's hard to like look at anything else and be like, why would you do that?
Yeah, this is one of the things that just totally sold me on multifamily.
Yep. Cool. So for you guys at home, make sure you tune in next week for that. Before you go, do us a favor, leave a review, hit the subscribe button, leave a like, just to start pushing buttons, as Dan likes to say. Give us some feedback,
And
help the
hit the
algorithms,
bell.
hit the bell.
Hit the bell.
Yeah, hit that bell, ding the bell.
Hit the bell.
And we'll catch you guys next week. Thanks for joining us.
Thanks, guys.
Later, guys.